slow growth. And I think that's really baked in the cake because we had a 10-plus year period of time where we effectively stole some of the future growth in our economy by borrowing money and effectively getting a little higher growth during the past 10-plus years. So we've got debt in the consumer sector and debt in the governmental sector that over time needs to shrink relative to personal income and relative to GDP. And that takes a hole out of the average growth rate. I believe that means we're coasting on average closer to 0% growth. Maybe we're going to have on average 2% growth, whereas you would expect 3, 4 plus coming out of a deep recession that we have had. And economists have written a lot about this. We have a lot of, and so when we are growing that slowly, dents in confidence, like the debate we had about extending the debt ceiling, like what's going on in Europe right now, the 1 or 2% or whatever effect they have on growth rates are more profoundly damaging than they are in a more vigorous recovery.
Well, let me ask you, Wilbur, everybody talks about what happened in Washington last August. Is confidence taking a hit because of the lack of leadership on both continents, or is it simply a function of the economic times that we're in and the fact that, as Ken Rogoff would say, it just takes longer to get out of a credit-induced recession?
I guess I did this.
I don't know if yours is working.
Is this working all right?
Just you, John.
This may be a partisan act, but he needs to use the mic and I don't. I think maybe the aberration was 07 rather than the aberration being where we are now. I think it was an outlier data point, as Ralph said, fueled by inordinate amount of debt. So I think it just postponed coming to grips with the kind of adjustment period that we're in now. So I agree it's going to be relatively sloggy for a relatively long period. Frankly, whatever the administration does. But I believe the administration has compounded that by A, walking away from the report that its own commission rendered in the past December about the budget. I think that was a huge mistake and a huge letdown to the American public. I also feel that demonizing Wall Street and frankly business in general has not helped with either consumer confidence or public confidence in general. In fact, I've never quite understood why if you're for employment, you would be against employers. And things like the Boeing decision that NLRB is putting forward, I think was a grievous mistake, came at a terrible time, and probably will result in jobs being lost to the country overall. So I think that it's more complicated than the numbers. I think a lot of it is the psychology of this one.
I'm tempted to say, Peter, defend yourself. But you did get out of the administration before the commission reported and before we had the budget negotiations this summer. You're a long time, you're not in Washington anymore, but a long time veteran of Washington. Is it worse than we've seen it in a very long time in terms of partisanship and the ability to get things done? And should people on Wall Street and in private business forget about Washington? Try to make things work without government help?
Well, first, I think it is different. I served in the Clinton administration, as you noted, and Washington is a different place now than it was even 10 or 15 years ago. And one of my concerns, I want to come back to the economics in a second, but one of my concerns is the polarization that you saw play out so vividly in the debt limit debate strikes me as being structural. It's not an ephemeral thing. It's not going to be fixed over time. I think it reflects deep structural forces in our society in which we are physically and virtually surrounding ourselves with like-minded people. And when you put like-minded people together in a group, they go to extremes as a group. And we basically, I think, need to stop believing in someone mentioned the tooth fairy before, the Civics 101 tooth fairy, that somehow this will just be erased instantaneously by a hero on a white horse or something changing. We are going to have this kind of structural hyperpolarization for an extended period of time. And we need to figure out how to live with it, because at this point, inertia leads to a whole set of bad outcomes. The hard slog of macroeconomic activity for the next several years, a fiscal path that is unsustainable, et cetera, et cetera. So often, inertia is not such a problem. Now it is. We need to figure out ways in which the gridlock, which leads to inertia, does not lead to inaction. And that means lots more things like automatic stabilizers, backstop rules that happen automatically if Congress doesn't act, commissions that have the power to put forward proposals that Congress can overrule, but that if there's no action, they take effect, and so on and so forth. And in answer to your question, maybe the way to answer it is to answer the question that you asked earlier. I think we're in for a period of years of a hard slog regardless, because the evidence suggests following a financial slump, you grow slowly for a period of time. But we shouldn't fall prey to the fatalism of, therefore, there's nothing policy can do. You can take the edge off a bit. And in fact, one of the flaws, I think, in the policy world has been to position this, or to frame it and see it as a deep but very temporary problem, a V shape rather than an L. And that leads to lots of things follow from that. So if you're in an L-shaped Reinhart Rogoff kind of world, you ignore housing at your peril. Anything you do in housing is going to have downsides. But if you're in a world in which you think the downturn is deep but temporary, those downsides might dominate because housing will come back anyway as the economy does. If that's not the case, if we're in Reinhart Rogoff hard slog world, you have to throw the ball long on housing, because that's one of the key transmission mechanisms to keep the growth rate down. Weak economy onto weak housing, back onto weak economy, as just one example of, if we correctly diagnose the problem, policy then follows from that diagnosis.
But the Obama administration did not throw the ball long on housing. Can it still do that? I mean, you're in the markets. The housing mortgage situation is so complicated. So many people own portions of these different mortgages. Is it a hopeless task, or could something be done?
Well, first of all, I think they have a very hard balancing act, because what we really need to address the longer term problems, which are the more fundamental ones, are a major focus on making this country more globally competitive. And that means, number one, addressing the mix of spending in government. We need to be spending more on investment, on things like infrastructure, on R&D, on education, and less on transfer payments, quite frankly, which is not something that Democrats necessarily want to hear. And number two, we need to seriously address the long-term fiscal imbalances and take $4 to $5 or more trillion out of the next 10 years budget gap, probably through a plan that's balanced, predominantly spending, but some revenue as well. So to me, that is, whatever is done, we have to keep our eye on that. And where the debate comes is, we have this 9+% unemployment rate, 16+% underemployment rate, and when you have a situation like that, there's tremendous impetus, as Peter said, in the country to do something. And I think there is more debate, quite honestly, about how do we get the economy moving a little bit better than it is today, and what is the appropriate actions for that, than there are about what we need to do to fix our long-term problems. Housing is an unbelievably difficult problem. Ironically, what was a tremendous so-called financial or markets advance, that the people who made the loans didn't have to hold them through securitization, has made it devilishly and legally staggeringly challenging to deal with this problem. And we can chip away at it. I think the government can probably, there are a lot of mortgages that are government owned or made today, and those we could probably, reduce refi. But, we have to recognize, at the end of the day, that's not a whole lot different from a targeted tax cut for the people who are borrowing that money.
No, I just ask you, you mentioned a balanced program. Would you pay higher taxes? Are you willing to pay higher taxes to help bring down the deficit?
Absolutely. I can't afford to pay quite as much more as Warren Buffett can, but I'm definitely willing to do more than my fair share and to pay a lot more than my secretary.
Might as well put you both on the record. Do you think that that's a fair solution, that we should look the higher taxes to people in the upper brackets?
Well, I think it's inevitable that something like that would happen. I don't think, though, it should be done in a punitive and discriminatory way, which is really the way that it's being cast. It's being cast in a way that helps to trigger class warfare. And I think if the unemployment doesn't come down and all this rhetoric doesn't get toned down, we will have social problems in the country. And I think it's a terrible, maybe a good political idea. I think it's terrible for the society to have that going on. I also think they've defined incorrectly the problem with the housing market. The whole approach so far has been take people who fundamentally can't afford their property and are underwater and find a way to keep them in it. I think you really need a clearing mechanism. You don't do anybody a favor to keep them in a property they can't afford. It was a mistake to put them in the first place, an even bigger mistake to keep them there. And all that's really happening is you're penalizing savers at the end of the day. We've been having a whole history in this country of recent generations of savers subsidizing borrowers, and I think that's a fundamentally wrong mindset.
I think the record would show you nodded your head when I asked about taxes, that you'd be willing to pay more.
Yeah, but I also think, look, it is also the case, we are, just to be blunt, running the federal government over the medium to long term on a revenue base that is inconsistent with what we're asking it to do. And the thought that we're going to make all of the adjustment and 100% on the spending side strikes me as implausible. And I think the revenue increase over the next 10 years or so that is required is significant enough that it will probably have to be broad-based rather than just upper income in order to get to the numbers that are necessary.
At this point, is austerity a good thing or bad thing for the economy overall? I'll start with you, since you've obviously done a lot of work on it.
This is what I'm frustrated by. The jobs versus austerity debate is a sterile one. The answer is we need, in my opinion, we need more of both, especially in a hard slog kind of scenario. You cannot ignore the out-year deficit problem, and in a Reinhart-Rogoff world, you have a rapidly rising debt, so it's important to show credibility on reducing that out-year deficit, but it doesn't need to take effect today when it is macroeconomically harmful. So the right combination is more support for the economy, and that means larger deficits in the short run, coupled in one package together with a lot more deficit reduction that's enacted now that takes effect later in time.
Do you have confidence? Wilbur, go ahead.
But how do you enforce that? That's the problem. We've had promises before that will fix the deficit long term. I don't think there's enough credibility in either the Congress or the administration that they'll live up to those promises. So I think there has to be a matching.
Can I comment on that? Because I agree with that. One of the things that we need to do, well, first, the history of past experiences with gradually phased in changes is not quite as bad as it sometimes seems. But you do have to worry about, promises that in 2018 we'll suddenly get religion and reduce spending. I would personally be in favor of, this is where inertia can actually be quite helpful. I would be in favor, for example, of changing the rules in the Senate so that not just through reconciliation, which is the way it's currently framed, but any deficit-reducing measure only requires 50 votes, and any deficit-increasing measure outside of a real economic emergency in the short run requires even more than 60. It requires something like 75. So that it becomes harder and harder to say, I'm going to do X, and then when the time comes to waive the rules. It's still possible. There's no way to absolutely pin down future Congresses, but I think we should make it harder and play off of the inertia that we now have given the polarization in the system.
As I noticed, the Democrats are only calling for that now that they're not in control of both houses.
I haven't heard any Democrats call for it, so.
All right, first one right there. Ralph, you put companies together. Have you seen a real loss of confidence in the future that will be reflected in much slower growth, much slower M&A activity going forward, or are people willing to act if they just get the right sign?
Well, I think confidence has been, hurt in the short run by the failure of our government to reach an elegant and easily reached solution with respect to the debt ceiling extension, and confidence is further hurt by what's going on in Europe right now. But I think the more fundamental question, and that has to be addressed. People don't commit capital, they don't start businesses to the degree that they do in a more buoyant era when they're worried about the future. But there's also a real lack of clarity about our economic future right now, which is hurt even more by confidence. So, I think we're in a period right now where businesses are a little less likely to form, where banks and lenders in the more credit-sensitive markets are a little less likely to lend. You can see that in the widening of spreads in the high-yield market. You can see that in the decline of activity in the leveraged loan market and the widening of spreads in that market. So, we're in a global period where people are pulling back from risk right now, and that is something that ultimately has a dampening effect on growth.
Of course, there's also opportunity in these situations. Wilbur, you were telling me that you found a country going through all this, but you're willing to commit capital to it. You've made a big investment in the Bank of Ireland.
Right. Yeah, and I think the Irish example is quite interesting. They have been a miracle in Europe, as you will know, for quite a while, because they have the lowest corporate tax rate, favorable trade balance, young, well-educated workforce, good IT and transportation infrastructure. And they're the only English-speaking country using the euro. Those fundamental advantages are still there. What happened was their banks went quite crazy, including Bank of Ireland. And when they ran out of bad loans to make in Ireland, they went to Spain to find them, they went to U.S. to find them, whatever they could do. But it's a singular event. And once they work that through the system, the fundamentals will come back. So what did they do to react? They cut the entire civil service cost 13% in one shot. No strikes, no riots, no burning buildings, no nothing. Second, pretty well cut out all government capex, cut back social services. Totally antithetical to Keynesian theory, because the economy was already a little bit weak. They're having positive GDP growth, not big, 4 or 5 tenths of